Hello, welcome everyone. Apologize for the delay. Let's get underway here. I want to spend a little bit of time we'll go over market conditions and kind of where we're sitting right now, and a couple of different ideas, as well as uh, um, a morning routine or a process, or even an evening routine as far as things to follow. Typically, if you're following my morning updates and then either attending these on Tuesday, Thursday, or watching the recording, you'll see a typical process, typical flow in terms of what the explanation of the market signals, and then drilling down into what an action, what are some of the actions that we want to consider. Now, in investing and trading is really specific to individuals, and there's 1,000 different ways to do it. And so our methodology, the time frame for the most part, is a position time frame, where we're holding on to something for anywhere from 2 weeks to 2 or 3 months on the long end of a trend, and even shorter than that on the shorter end of a trend, just because we're utilizing a stop loss process. So that time frame allows a little slower process. It's an end of day process, an end of day signal, which means that we're not doing, for the most part, we're not doing things during the trading day. We're setting it up either before the market is open or after the market is closed. And that also is on purpose, because it allows to have some structure. It allows to create a plan, and it allows to create just a systematic approach. If you enter a trade one way, and you analyze a trade another way, and you use a stop loss in another way, and you sell based on a different target, that's just guessing. Okay, there's no system to that, and ultimately you're going to be frustrated if there's, well, why am I buying this stock now? Well, what is my risk on this stock? What do I do if I'm wrong? What do I do if I'm right? What do I do, and how much should I be putting in? How much risk am I actually taking, and can I afford that risk? Do I have this money to lose? Because any trading money, at least depending on the style, again, if it's longer term money, and it's not Vegas play money, which in my opinion, no money should ever be Vegas play money, but it's money that is that is at risk of volatility. Anytime you ever venture into a stock trade, there's always risk of downside. And that risk is potentially for a trade-off of a reward of some type. And ultimately, we want to have more reward than we have risk or losers over time. But we can't avoid the risk if we want to try and get the potential return. So in terms of really swinging for the fences and getting a real big home run, and blowing an account just really out of the water and really having things take off, we're gonna get a handful of those trades over time. But would we ever have all of our money in one of those stocks? Never. Might someone else do that? Yes, certainly. That's why I say everyone, fortunes are made and lost every day in the stock market, because people do stupid things, and they take big risks, and sometimes those risks pay off, and sometimes they don't. So we're not in that game. We don't want to be gunslinging, risking a lot. At least that's the methodology behind it, to create a little bit more functionality and a little bit more systematic process. Now, going into that, we want to look at two things. We want to start essentially the day by what is our bias. Okay, what's the market doing in the big picture? Is it moving up? Is it moving down? So we start off with this direction alerts, and it's always a glance. If you'll notice, I go through this pretty quickly, because it doesn't change very quickly. It's a very slow moving process. And ultimately what we're waiting for, or watching for, is in these trends. Now you'll notice these arrows are not they're not the exact top, and they're not the exact bottom, because that's not what trends do. Okay? Picking the exact top or picking the exact bottom is not what we're in the game of doing, and that's a hard game to play anyway. Although a lot of times we can get pretty close on that, but what we want to do is just recognize, are we in a downtrend or are we in an uptrend? And then from there, are we at the extreme of that trend one way or the other? And so from there we can say, yeah, well, we know that we're at the upper end of the trend. We know we're starting to slope down. We also know that we are bearish in a bull market here, which that bearishness is that we're in a sell signal on the S&P 500. We've got all short-term indicators to the downside. Breadth is moving down, buy-sell ratio is moving down. Okay, so in the shorter term, we know that we are in a downtrend. We're bearish, we're moving lower. So those are two quick things we can look at in about 15 seconds in the morning to say, where are we at in this bullish trend? Are we up? Have we gone a long ways? You can use third grade terminology too. It helps me to be able, if I can explain this to my 12-year-old, and then I ought to be able to understand it too, right? So it's simply, are we moving up? Are we moving down? How far have we moved? How far, and can we move higher without a pullback first? Okay, and ultimately, the long-term overall bias is betting America. Okay, and that is S&P 500 is going to go up forever. Okay, it's going to go up because the stocks end up getting replaced in the index. The S&P of 10 years ago is not the S&P of today. The S&P of 20 years ago is absolutely not the same S&P. So those stocks they change. And so the overall bias in the long-term approach of stocks is you're buying companies that are profitable. These are growth companies. Well, a company is a growth company. Analysts break them into value and to this and into that, but companies are designed to grow. That's what any business owner wants, is growth. If it doesn't happen, the business is starting to fail. Okay? If a flatlining business is not a business, it needs to be growing, and over time. And yes, you have ups and downs, and you have ebbs and flows, and some market cycles are different than others, and some businesses figure that out and some don't. Okay? But ultimately, we want to be able to participate in the growth of these companies, and that's why we invest in the stock market. And the most basic way to invest in the stock market long term is to say, I'm going to buy the entire market, okay, or I'm going to buy the index. So I'm going to buy the top 500 companies in on this planet, and I'm just going to buy it, and just going to sit on that, and I'm going to wait, and I'm going to ride out the volatility, and when it drops, I'm going to buy more. Okay, that's a typical real long-term investment approach to be able to adding into an investment account over time. Now, the issue with that is sometimes we run into situations like this over the last few years. Okay, I can go all the way back. Well, let me go back here. Sometimes we run into situations like this where our account has been moving higher. Maybe we were up 20, 30, 40, 50%, and then we're down 20, 30% over this year. We give some of that back, okay, and then we ride it out again. That process of this long term for the last 20 years, if all you did is just bought into something and bought into the S&P 500 and diversified out and had a certain amount of your assets in that for the longer term, then you're doing great, okay? But you needed two things. Number one, you needed 20 years. And number two, you needed to understand what you were doing. Was that a methodology or a process that you wanted to be able to use? Okay, so that being said, there's lots of different ways to be able to approach that. So we want to approach it then and say, yeah, we want to own stocks, and we still want to try and own them at the best times. And the downtrending markets are tougher to trade. The stocks that are going, when the S&P starts selling and all of these large institutional algorithms start triggering sell signals, it just sells everything. So bear markets, or bearish trends, I should say, we're not in a bear market, but we are in a bearish trend, are harder to trade. So you could simply say, I'm going to sit this out right now because I do not want to I don't want to ride the volatility. I don't know if we're going to go higher from here. We potentially could go lower from here. That's not a risk I want to take. I'm going to set a certain amount of my assets aside, and I'm going to pick in some individual stocks with a small fraction or a small percentage, maybe 10 or 20 or 30% of my holdings. Okay, so that's the plan. That's the trading plan that you want to have set up first. And then as you're entering into that plan and you're executing that plan, then you're able to follow a process, and then you can also track that process as well and say, how am I doing? Did I follow my plan? And so if that is a part of this, and that is a significant part of it, is what market conditions are conducive to uptrending stocks. These are tougher stocks right here, or tougher environments for most stocks to continue to move higher in. And that may be one that you want to sit out. So that could be a part of that first step, is say, what are market conditions looking like? Well, we know where they're at here in the long term. Buy-sell ratio is bearish. But maybe I also would have said sentiment is really oversold right here. Maybe I want to try and take advantage of a bounce, or a shorter term bounce from that perspective as well, once you start getting around those extremes, those edges. Okay, so then we also glance at the sectors and say, what are sectors doing? Because sectors also give us a confirmation of that analysis that we just looked at. So if we have the long-term directional alerts, which is higher, but it's extreme, and now we're trading lower and we're bearish, well, we could also look at this and say all of these different sectors right now, we've got about half sell and about half hold. Well, that's that's about a buy sell ratio of about 1, and that's about where we're sitting currently. We're less than that, significantly less than that actually, 0.47. Okay, so buy sell ratio less than 1, we know that bears are in control. We can also simply mouse over this and say 1900 downtrends to 900 uptrends. The bulk of those are in downtrends now, and we also can confirm that with our index buy sell ratio. So we can say S&P 500, 182 versus 75. That's a weakening trend, and you're seeing more and more of these stocks that are creating or having or in weakening trends, and that is just a function of more stocks going down than are going up. That's all the S&P 500 is doing right now, is saying those stocks that are in that list are currently, there it went, of course, right when so a lot of these stocks here, so you're getting, Applied Material, you're starting to see these upward trends. These are strong S&P 500 companies that are starting to, they're still in the momentum zone, at least on this 1-year time frame, and even on the 6-month time frame. But we're getting more and more of this. So we had a lot of them just cruising higher, and now we're getting a bulk of stocks, a group of stocks, in this case 189 of those S&P 500 stocks, Netflix. So you're seeing stocks like Netflix. All of these stocks that were moving higher in this uptrend are now starting to retrace a little bit. They're starting to break down. Caterpillar is another one. Okay, so when you start to see these, we obviously are in this correction, and it's needed. Stocks just don't go up, and markets don't go up forever. And some of these retracements are needed to give a new breath and some new demand, and kind of a reset of valuations to start to go higher. But that being said, it can also go a lot lower, and these are the early stages of that. So that's the balance right now of, do we bet aggressively to the upside, hoping that it goes higher, or do we realize that the fact that market conditions are at all-time highs, they're starting to weaken, we've got interest rate risk, we've got inflation risk, we potentially have earnings risk. Now we're getting more and more, nasty gap downs. I think it was Starbucks that just got obliterated yesterday. I don't know what that was, but percentage down. It's all the way down here now, and you can see Starbucks. Not that it's a bellwether, but it is a kind of a consumer type of stock. People are buying their fancy drinks and fancy bagels, and they're not doing that right now. So maybe consumers are tightening up a little bit. Not that that's my point being, some of these companies they're just retracing, and we're getting a larger and larger number of that based on that. So that's a quick glance to say, all right, I'm not going to add anything new today, or I'm going to reduce my risk exposure right now, and I'm just going to sit on my hands for a little bit right here until I really feel a little bit more confident about what's happening. That's that big picture process, understanding your buy sell ratio, and then from there you can looking at the sectors. We're obviously looking at commodities as well, because that can make a difference when some of these stocks that we're trading. If we have some gold stocks that are coming in the new buy scans, and we also know that gold as a commodity is moving higher, then that can also just bolster that idea, that trade idea, that we want to buy gold stocks, gold mining stocks. Well, if gold is moving down, then that wouldn't make much sense. Where gold is moving higher, some of those that are moving in that new buy signal can give some additional confirmation there. Same with USO. So those are really kind of the two big ones. And you can see USO, which is oil, is retracing back down again. this actually could be a good thing. So we may see a retracement in oil. That typically helps equities here as well. We're also seeing interest rates. We didn't see much in interest rates the last few days as well here, but up a tiny bit there today, not much. Okay, so from there, then you go in and we've taken a look at the new buy list. There's several ways you can do this, as we've talked about. You can create your own new buy list, your own custom scan, and say, okay, I'm going to, I think we did this, I'm only going to focus on stocks from a live or from a scan that I created. Okay, and then I can have some customization to that scan. In this case, $10 or higher, any stock price $10 or higher, large market cap. We want big companies, lots of volume, 1 million shares or more. PE ratio, we want at least some earnings, and we want a signal that has changed from hold to buy and a rank that's at least 70. Okay, so that's a little more custom than just taking my new buy list, which is a lot wider, $2. It's gone from a hold to a buy, and it's got increase, or it's got its rank at 70 and increasing volume as well. So we do have an increasing volume component on that one, but you may want to say, all right, though, this is fine. I'm good with this. Here's my 21 stocks. Let's take a look here and let's start out. So this would have been this morning before this move right here. Okay, it's up 3%, and it went from a hold to a buy, and it's in the momentum zone here. Okay, so it's pulled back, it's finding support, it's gone from hold to buy, and there's your confirmation bar and some decent increasing volume right there. Sorry, my dot's a little bit too big, although it's helpful. My eyesight's getting worse and worse as I get old, and so I've got these reading glasses, but sometimes I can't see my monitor, and I've got to get my act together with my reading glasses. It's kind of funny because you get a pair on your shirt collar and you get a pair on your head, and then you can't find either of those pairs. Good Lord, right? The fun of aging here. Okay, where was I at? So our support level 60. This would be one stock that would be inside of my candidate list for that day. Now, one of the other things you can do, one of the things you're going to start to see, if you've been following these patterns a lot, you're going to start to see stocks that are in a retracement and they're right at this support level. Sometimes they can do that, and you might say, I'm going to take a stab at an earlier entry here. You can still set your stop loss every way we need to. Maybe we'll find a candidate here real quick. But for the most part, this is that process of going through and saying, of this list that I've got, of my custom screen, FTAI was the top of the list because it's been the best performer. But you've also got Pinterest, Garmin, Radnet. Okay, so I could say, let's look at a few of these. Now, what I might be looking at is something like this. If I've got a group of stocks and I'm saying, that's a pretty big gap right there. For me, that's hard to manage risk on a big gap like that, because I like to set a stop loss below a most recent area, either the low or a sell signal if things are turning. So I would look at this and say, that's going to be tougher for me to manage the risk profile on that if I have to set a stop here. Then I don't know. Maybe I could set a stop down here. I could still do the same thing, but I don't like that. It's a last resort sometimes if I'm looking for candidates. But the other thing too is this was a massive gap on massive volume, which means you have this gap, this distance is real price value. Okay, maybe it happened pre-market, but it was real price value. So there was price activity happening here. So I could say I want to buy it here, and I'm still going to set my stop the exact same way that I would. And maybe this is a good instruction, because you'll see these a lot in this new buy scan, lots of gappers. And so if I were to buy a gap stock today, this stock had gapped yesterday, and I were to set that up, I would essentially want to do the same thing. If I'm buying it right here, let's say that I needed to let's say for the risk management, I decided I wanted to set my stop down here, and let's call that $37. So $37, I'm going to go here. I initially just have this portfolio. Again, you can add in one that may be closer to your account size, so that you can use this as just a quick tool to give you a ballpark idea of the number of shares you need to go to enter into. Because we want to do two things. It's a $40 stock, so let's say 50. Oops, I didn't want to do that. Let me add this in. 50 shares. 50 shares is at 1.12. Risk allocation will typically do that number, typically between 2 and 2.5%. In really bullish markets, you could go all the way up to 3 or even up to 5%. And in a little bit more bearish markets, you just pull this number back. This is how we're managing risk in a portfolio, is we're just buying less shares. We're taking on a smaller position. You can, but again, that's within this portfolio's trading plan, is when stocks are bearish, I'm taking less risk here, less than the 2%. But at the same time, I don't want to go too low because some of these stocks are taking off. For example, let me go here. Actually, let me finish my frame of thought here on this first, okay, with a stop loss. So let's come back to 37. So this gives us 1.12. If I set my stop at 37, I've got $156 at risk on that trade. So if I decided I did want to buy that gap, and I'm going to set my stop at 37, which is right here. Basically what I'm saying is if it retraced all the way back and said, well, dang it, I'm out. I can't afford to see if it does this. I can't afford to see if it does, this and then moves higher. I've decided this is what I can afford to risk, $156. And so if I'm wrong and it retraces, I still may be right, and it may retrace all the way back and find support and then move higher. That's the hard part of buying into a gap like this, is if it does retrace. But at the same time, you do have momentum in some of these trades, so you can still do it, but just make sure you're doing it with this process, and then you're good. You've got your parameters in place. Okay, so that's the other process, is know your portfolio, your amount of risk that you want to be able to implement, and then just simply have that process of knowing how many shares can I buy and where do I need to place my stop loss. Okay, for uptrending momentum trades, that's all we need to know. How many shares am I buying and where's my stop loss on those trades? And then we're going to hold it as long as it's trending higher. The minute it retraces lower, or we adjust our stop loss higher, and it hits that, then we're out. Let me go to that example I wanted to go over, because we had a couple of days ago in the wheel portfolio, in our Discord group, we bought into MAX on this bar right here. Okay, and so it gapped higher. So and it's retracing back today, and this is a part of that bearishness of the market. Okay, but it's had a lot of volume happening right here. And my point of this is, even in downtrends, you're going to get stocks that have this potential. Whether or not we actually catch it or not, that's another story. But we've got to try, right? We've got to keep taking stabs at these every single day. Is the way that I approach that, just with smaller position size. So we end up making quite a few trades, but they're just small. They're smaller position sizes, so that we are managing the risk with position size and stop loss, instead of having a 10% holding of a bigger position. If that were the case, I would want to have a lot of conviction in that setup. And a lot of that, in this case, a lot of times we're focused on the price pattern and the fact that it is already moving higher, and it's strong and it's ranked high and it's retracing and it comes back into that trending zone with big volume. I've got to trust that process. All of this, what they're doing, who's manipulating what, who's trying to stop me out, who's trying to, everything that everybody always talks about, it's irrelevant when it comes to the fact that I've still got to make a decision. And I can fear, okay, I don't want to have a stop loss because I heard that there's all these market makers out there and all they want to do is hit my stop loss. Okay, well that's what they're trying to do. So, but if you get stopped out, you determined the price that you're going to get stopped out at. So what's the big deal? The big deal is that sometimes people get stopped out. The market goes up, you get stopped out, and then it immediately goes higher. Okay, well, if we're stopped out, it's typically going to be a yellow or a red, and then it'll come back to green, and we'll have another opportunity to buy back in, which is fine. I'd rather do that than have a big loser. I'd rather have small losers and more of them, and then re-enter something that looks like it may have an opportunity. So they're out there. We're just you know, we get one or two. We haven't had any real big ones recently. That portfolio has been, we've had some ups and downs in there as well. But that's the process that we go through. So you can decide your scan, okay, or you can use whatever that process is. And there's a lot of functions in there that you can tighten that up. Maybe you want to make sure you don't have anything that's in extreme. Okay, so for example, FTI, it may not scan in there because of that move today. But if I were to take that and I were to say, I don't want any momentum that is higher than 140. So the max I want is 140 on momentum. Okay, that's going to give me stocks that are not extreme. So let's see if that reduced that at all. So that took us out of from 21 down to 13. So there were a few in there that had big moves, and they were up in that extreme zone. If I want to look at a list that are not in that, then I can create that. So essentially what I'm doing is I'm just creating my list for the day or my potential trades for that day. And I've got my own scan, and maybe I've got, okay, maybe I want, oh, that's gonna, where did I go? It deletes that. When you move back, it'll remove that and delete it. Okay, but maybe I want to have even more criteria on this. I want 140 and I want a dividend. Okay, at least a 1% dividend. Okay, it took us from 13 to 8. Still some nice, these are just now, that's a really high quality scan I've got now. Okay, and I'm gonna go ahead and save it. I can either update the one I have, okay, since I've edited the one I have, or I can create a new one. Let's do live class new just for fun here, and we'll create that and we'll save that. Okay, now I know that now I know the criteria of this group of stocks. Back here it was a hold or a buy. Okay, momentum. It's got some nice continuation on it as well. That again, this is just not saying this is one that you should do, but it's just one that helps determine the number or the actual number of stocks. And if you're like, I don't want these biotech names, they're too risky, they're too volatile, I don't want, you know, well, the downside of that is that some of these names that show up in this new buy list or these muscle stocks can do something like this as well. And then I'll finish on this last note. I was a little bit late to get started, so we'll run a little bit longer. But we've got one also, BDX. This is a trade, a little biotech name. Really, you know, really aggressive, really volatile. We've seen these stocks go up and we've seen them, you know, give it back just as quickly. But these are the kinds of stocks that can move 30, 40, 50, 100% in a short amount of time. And we still want to be able to try and catch some of those. And so this would have been a new buy scan that it was. In fact, it was right here from hold back to buy. It popped in. I think we bought it in the portfolio either here or maybe even back here. And it's been doing a whole lot of nothing. Haven't been stopped out, but you know, this market's been moving sideways. Biotech, medical drugs have been doing really well. And so we want to be able to continue to stick with those trends as they're beginning. Okay, this one potentially could run into some resistance, some breakout, but these are kind of the fun ones sometimes. So if you are like, some of the scans that I've changed to are too tight. Okay, they're too aggressive, like this. You know, maybe I've got a 20 hold to buy. This is one that's a really tight scan and usually doesn't even pull in anything. Okay, but here's an example. So look at the numbers here. So it's had massive earnings just recently. Probably it's a medical drug, biotech. Who knows what that money was from? Sometimes new investment money comes in and they'll report it as earnings, and it shouldn't be, or it could be a big order, or they could have been, again, that would require a little bit more homework to dig in and find out what it's actually doing. But in this case, that did pull into my scan and said, man, these guys have, you know, 620 million market cap, 650,000 on average shares traded per day. I don't know why it pulled in. Maybe I didn't reset that dividend amount. It is pulling that as a dividend, or I didn't save that. Let's double check. Oh, right. I don't have a dividend on this one. I was thinking that last scan we had. So you've got these options. These are the default scans. These are fast and easy, and you're going to get a ton of cool stuff in here. you know, lots of new buy signals, lots of a lot of volatile type trades. But the process is very simple. I can look at any stock at this location with this setup, knowing it's uptrending, knowing it's in this momentum zone, and this is the only thing I need to worry about is this bar right here. Okay, I don't need to worry about any of this anymore. I know that it's helping. I know that there's support. I know that it's uptrending. I know all that. Okay, and it's obviously here on the chart. But if I think too hard about all this, it's going to affect the decision that I make on that bar. Instead of saying, oh wow, here's an uptrend and I want to buy this stock, how many shares could I buy? Yes, it's extreme, but you know, so what? I'm taking the bar. It's a momentum trade. Let's look at the number of shares that I need to trade. If I have a $100,000 account, $8 a share. Let's say if I'm 500 shares, oh, that's a little bit much there. 200 is at one. So 200 shares of this stock is 1.6% allocation. And in this case, I have no stop listed, so it's $1,700. So if there's no stop listed, that's going to tell you your portfolio percentage at risk. Once I add the stop, so let's add a stop and say, oh, let's go all the way down to $7 and see what that does. Okay, $7 stop loss. That puts me at 0.3. So 342. Because of that big move, that's a really wide stop. It's a really wide stop. We're going almost all the way down here. We could set the stop just at the low of that bar right there. Okay. Either way, this is almost inside of that allowable range with a stop loss all the way down here. So if I'm saying I'm going to place a trade on this stock with the anticipation, okay, my expectation is what? My expectation is that the trend is going to continue higher. The path of least resistance at this point, once you get this momentum and it's building momentum and it's had momentum, even from all the way back there, then my expectation is it's going higher. Well, if it doesn't go higher and I have my stop loss placed at $7, which is right here, then this is my risk. If I'm wrong and it comes back down, I shouldn't even say if I'm wrong because it's not I don't have any control. Okay, the market has all the control. All we have control over is this. We have control of when and where and why we enter, and we have control over the number of shares and our stop location. We don't have control over anything else. The market does. So we can't beat ourselves up or say, oh, I'm such an idiot, or oh, I'm such a terrible investor, or oh, because well, which parts did you not control? Okay, the market has control, but the pieces you have control over, did you not buy on a new buy confirmation? Did you not place a stop loss? Was your position size too big? Because there's going to be times where they gap lower or something in the news, or short sellers are jumping in, or whatever the case may be that can tank a stock, especially a stock, one of these medical biotechs. They're high risk, high reward type of trade. So you want to make sure that you understand that, and then make sure that you are protecting your risk by setting a stop loss in place. And the stop loss is all about you. The stop loss is all about you and your risk management. Who cares what, if there are people that are out there that are trying to fill stops, I guarantee you there's 10,000 things happening behind the scenes that we have no idea about. It's like the Men in Black movie. It's like, when it comes to institutions and everything that's happening behind the scenes of the markets, I guarantee it's just a giant shit show, and we have very little control. But they're massive worldwide trillion-dollar marketplaces. It's pretty hard for a few bad players to jump in there. But so we shouldn't necessarily think that the world and the markets are against us. Let's focus on what is working, and then let's set up our methodology. So in this case, that would be an example of a methodology. It's an example of a process I would be following by saying, market, in this case, market conditions are bearish, but okay, I'm still adding into positions. That means that I'm going to take a little bit smaller risk. So I would say, all right, let's change our stop loss here to below the 236. Which is at 771. So if I go 771 right here, let's just go 775. That changed my risk to 192. So now I've got a tighter stop loss. Okay, the tighter stop loss means that if it does trade back, I have the chance of it tagging that, hitting that, right near support, and then moving higher. That's the only problem with setting stop losses, relatively close to that entry is, it can stop you out, but that's okay because, most of them, half of them are going to move higher and move from there. So hopefully that was helpful. Went a little bit longer than normal, and I'm going to end on that note, and we'll see you next week. Everyone have a fantastic weekend, and we'll see you then. Bye now.